A bank client can choose to open checking accounts vs savings accounts depending on several factors, such as purpose, ease of access, or other attributes. A checking account is a type of bank account that is used for everyday transactions. It is the most basic account that banks, credit unions, and small lenders offer. On the other hand, a savings account is a bank account intended for storing money. It is where people keep money which they don't need to use right away. Unlike a checking account that does not usually yield interest over time, a savings account helps individuals to grow their money, whether they need to access their cash or not. You've probably got a basic awareness of the two most common bank accounts, checking and savings. But if you're just getting started managing your money, you may not understand fully how each one works and how you can get the most out of them. Here are the important differences between checking and savings accounts and ways to make the most of them. Differences between checking accounts vs savings accounts. 1. Account fees. When an individual opens a checking account, the bank will require that it meets a certain criterion. For example, they may need to maintain a specific amount of money in the account. This amount is what is referred to as the minimum balance requirement. Some banks require their customers to make a minimum number of transactions per month. If the checking account holder fails to adhere to the given regulations, they are likely to incur monthly maintenance fee. Also, there are other fees that the bank or other financial institution can impose on a checking account holder. They include ATM fees, overdraft protection fees, overdraft charges, as well as fees for online access. The exact amount of the fees varies from one bank to another. In contrast, a savings account is typically free of fees. The only requirement for such an account is usually that the user does not exceed their withdrawal limit. However, there are some banks that impose a minimum balance requirement like the one for checking accounts. Bank of America requires users to either maintain a minimum balance or conduct a certain number of transactions. If not, affected customers risk paying account maintenance fees. 2. Interest rates. With most banks and credit unions, checking accounts earn little to no interest. Conversely, a savings account attracts interest. However, the interest differs from one bank to another. To determine the applicable rate, banks take into account two main things: the type of savings account maintained by an individual and the sum of the money deposited in the account. The interest rate of a checking account is always lower than that for a savings account. Online banks, such as Everbank and Ally, usually offer higher interest-bearing accounts than traditional banks. 3. Bill payments. When one opens a checking account, he will gain access to conducting a number of transactions. For example, the account holder is able to create an automatic bill pay function for recurring payments such as electricity and water bills. He can also use the account to make one-off payments. However, a savings account does not allow for such transactions. So, if an individual wishes to perform such transactions with money in a savings account, he must first transfer money from his savings account into his checking account. 4. Debit cards. A checking account often comes with a debit card, which makes it easy to access money through an ATM, as well as pay for goods or services. However, it's important to note that a debit card only allows the account holder to use money that is already in the account. Savings accounts are different, as they don't come with debit cards. 5. Restrictions/limitations. With a checking account, one can perform as many transactions as he wants. He can withdraw and make deposits an infinite number of times. However, service fees may apply to transactions beyond a specified monthly limit. For example, a checking account holder may have to pay fees for writing more than 10 checks in 1 month. Contrarily, a savings account is meant for occasional uses. Most banks place a limitation on the number of times that one can withdraw money from the account within a given period. The average number of withdrawals that one can make in a month is 3 to 6. However, there is no limitation when it comes to the number of deposits. A checking account is designed for day-to-day operations. Essentially, One is not limited by the number of transactions he can perform using the account. A savings account, on the other hand, is meant for saving money for a long period of time. The idea is to keep money in this account long enough to enable it to yield interest. Look for an account that either doesn't charge a maintenance fee or has an easy way to waive it. Some top accounts also earn interest, though rates may come with balance limits and spending requirements. Otherwise, checking account rates are generally lower than what top savings accounts offer. Along with no monthly fees, the best checking accounts tend to have free access to nationwide ATM networks. Some even have sign-up bonuses. Checking accounts also offer debit cards as a standard feature. This makes it easy to make everyday purchases. The best savings accounts have strong interest rates, no monthly fees, and offer easy online bank transfers. Look for accounts with rates that are around 2% annual percentage yield or higher and have no monthly service charges. You'll also want to look out for other fees. For example, some accounts charge for making some types of withdrawals, such as online transfers, too frequently. There used to be federally enforced limits on some of these convenient withdrawals, capping them at 6 per month. The primary benefit of a checking account is to provide you with access to your money for everyday needs. Savings accounts, on the other hand, enable you to set aside money for longer-term goals. Savings accounts pay interest on balances. Checking accounts generally don't, and the ones that do tend to offer very low interest rates. A checking account offers easy access to your money and flexibility in the way you pay for your purchases. In most cases, you're able to pay by writing checks or using a debit card. A third option is paying via the digital wallet on your smartphone. In addition, you can transfer money to other people and pay bills through mobile and online banking, or use an ATM to make deposits or withdraw cash. And you can check your balance, track spending, and set up alerts through mobile and online banking. A checking account can also receive deposits via transfers, digital deposits, and deposited checks through mobile banking. Most accounts come with a debit card for making purchases. You may have to enter a personal identification number or PIN to complete your transaction, with your purchase amount subtracted directly from your checking account. If you want, you can enter your debit card into a digital wallet on your smartphone, then pay using your phone. You can withdraw cash, make deposits, check your account balance, and transfer funds between accounts at automated teller machines, ATMs. But be aware of fees. Your bank is unlikely to charge you for transactions at its ATMs, but there's often a charge if you use other ATMs. Some banks and credit unions will reimburse you for those fees. Consult your checking account fee schedule for more details. Beyond allowing you to do your banking whenever it's convenient, mobile and online banking may offer a host of digital tools to help you stay on top of your finances. Among them, schedule payments for recurring bills such as utilities. Set alerts for unusual account activity, or when your balance falls to a preset level. Deposit checks from your smartphone. With some checking accounts, the ability to write paper checks may be an option. Additionally, all banks are required to generate monthly statements for checking accounts. You can choose to have paper statements mailed to you or receive them digitally. Do checking accounts come with any fees? In many cases they do. The most common ones are overdraft, ATM, and monthly maintenance fees. A bank may waive maintenance fees if you keep a set minimum balance in your account. The good news is that there are some free checking accounts and steps you can take to avoid fees. Always review the bank's fee schedule before opening an account and check into options for overdraft protection if you think you may need it. What are the advantages of a savings account? Because they're a known way of keeping your money safe but accessible, and because they earn interest, savings accounts are often the first choice for those looking to put aside money for the future. Many children learn about money through savings accounts with their parents. Teenagers use savings accounts for money from chores or jobs. And adults turn to them to build emergency funds or to help reach short-term, a car, a vacation, or long-term, college, a house, goals. It's not as easy to gain access to the assets in a savings account as it is with a checking account, which means you're less likely to withdraw funds for impulse buys. You may be able to set up automatic transfers from your checking account to make saving easier. What are savings accounts' limitations? Savings accounts offer relatively lower interest rates than other types of accounts and investments. They also may have a limit on the number of withdrawals you can make each month. You may be subject to fees if you make too many withdrawals or do not maintain a minimum balance. Should I have both checking and savings accounts? Because they serve different purposes, it can be helpful to have both a checking account and a savings account. Many banks allow you to link your checking and savings accounts, so you can easily transfer money between them. Linked accounts can help you avoid overdraft fees. And if you have a debit card connected to your linked checking account, you can also withdraw cash from your savings account through an ATM. One note of caution: this easy access to savings can have its disadvantages for people who have difficulty budgeting their money. Frequently dipping into your savings account will negate your efforts to grow your savings. A checking or savings account is far safer than carrying cash. You'll automatically enjoy the built-in security features offered by reputable banks, including passwords, protection against unauthorized debit card transactions, and online security protocols such as firewalls, encryption, and multi-factor authentication, all of which can help protect against identity theft and fraud. Opening a bank account, whether it's checking, savings, or both, is an important step toward managing your money and building your financial foundation over time. If you're new to banking, you may be curious about which account is right for you, checking or savings. Should you open a checking account to get access to a debit card? Or, should you open a savings account to take advantage of interest? Do you really need both? Learn more about the differences between checking and savings, and find out how both accounts can benefit you. The main difference between checking and savings accounts is that checking accounts are primarily for accessing your money for daily use, while savings accounts are primarily for saving money. Checking accounts are considered transactional, meaning that they allow you to access your money when and where you need it. While both allow you to access your money, you may consider it easier to do so with checking accounts. Since these accounts are designed to give you easy access to your cash, they often come with debit cards, checks, and even offer digital payment options like Apple Pay. In contrast, savings accounts have a limit on the number of withdrawals you can make each month. While checking accounts are convenient for daily cash needs, it's important to remember that they may be age restricted. Most banks won't allow people under the age of 18 to open a checking account without a parent or legal guardian as a co-owner of the account. Before opening a checking account, make sure that its terms fit your financial needs and your lifestyle. Savings accounts, money for long-term goals. When it comes to setting aside money for a long-term need or goal, you should consider a savings account. Savings accounts are designed to hold money over a long period of time to help you save for larger goals, rather than everyday purchases. As your money stays in the account, it will accrue interest and grow over time. For traditional savings accounts, this means that you will need to visit your bank, set up a transfer online one, or make an ATM withdrawal to access your money. A money market savings account allows you to write checks from it. Keeping some of your money in a savings account is a great way to set it aside for emergencies or large purchases. Its limited access will keep you from spending it on day-to-day necessities. There are also dedicated savings accounts for kids, though a parent or guardian is usually required as a joint owner. Checking vs. savings accounts, which is best for me? If you're trying to decide between savings or checking, it's best to consider what you need from your bank account. Ideally, you should open both a checking and a savings account to enjoy the benefits of each. Santander Bank offers a range of checking and savings options, including joint accounts, so you can choose the accounts that are right for you. Learn more about our personal banking products or visit your local branch to speak with one of our banking associates. We limit withdrawals and transfers out of your savings and money market savings accounts. You can withdraw or transfer funds from a savings or money market savings account a total of 6 times per service fee period, such as by automatic or pre-authorized transfers using telephone, online banking, mobile banking, overdraft protection, payments to third parties, wire transfers, checks, and drafts. If you repeatedly exceed these limits, we may close or convert your account to a checking account, which may be a non-interest bearing checking account. Thank you for watching this video.